I totally get it. There's about 1,001 different ways that you can be looking at calculating your returns on an investment property to decide whether or not it's even worth it for you to continue underwriting or even decide to pull the trigger and move ahead. Today, we're going to talk a little bit more about a very specific formula called the net rental yield and how it's similar to the cap rate, but also a little bit different, and why there's also a little bit more of a quicker and dirtier version of it to sort of get a really quick, litmus test to figure out whether or not a deal is even worth it for you to keep underwriting. And here's the formula for net rental yield. What you'll see is that it basically calculates what your total rental income is going to be minus your operating expenses over the purchase price of the property itself. This will basically tell you what your overall return is expected to be based off of the rental income and expenses that you have on the property versus what you're paying for it. Mind you, it doesn't take into account things like mortgage, debt payments, stuff like that. Now, if you look at this formula long enough, you might say, hey Mo, this looks really like the cap rate formula. Yes and no, right? The cap rate formula is different because it actually takes into account not the purchase price in and of itself, but the actual market value of the property.